If artificial intelligence is the new oil, then semiconductors are the refineries. And there is one company refining more advanced AI chips than anyone else in the world: Taiwan Semiconductor Manufacturing Company, TSMC. But here's the key institutional question. Is TSMC still a structural buy in the AI supercycle, or is it vulnerable to Federal Reserve policy, rising bond yields, and geopolitical risk? Let's break this down through a hedge fund lens. TSMC is not just another semiconductor company. It controls over 90% of the world's most advanced chip manufacturing below 7 nanometers. Its clients include NVIDIA, Apple, Advanced Micro Devices, Qualcomm. Every advanced AI chip designed by fabless companies ultimately depends on TSMC's fabrication capability. This creates massive switching costs, long-term strategic contracts, near monopoly power at advanced nodes. This is not cyclical dominance. This is structural infrastructure control. Now let's examine the financial framework. TSMC is capital-intensive. It spends tens of billions of dollars annually on new fabrication plants, advanced EUV equipment, process node migration, 3 nanometers to 2 nanometers. But this capex creates a competitive moat. Advanced chip manufacturing has become so complex that barriers to entry are nearly insurmountable. Margins remain healthy, especially as AI-related chip demand carries premium pricing. As AI accelerators represent a larger portion of revenue mix, profitability structurally improves. Now we shift to macro, where hedge funds live. TSMC's valuation is sensitive to U.S. 10-year Treasury yields, real interest rates, global liquidity conditions. Why? Because long-term semiconductor investment depends on capital access. Scenario A: Fed cuts. Rates, bond yields decline. Discount rates fall. Valuation multiples expand. AI capex accelerates. TSMC benefits both operationally and financially. Scenario B: Higher for longer yields remain elevated. Cost of capital rises. Multiples compress. Short-term volatility increases. However, unlike speculative AI stocks, TSMC generates real, tangible cash flow. It is less narrative-driven and more infrastructure-driven. The elephant in the room is Taiwan geopolitical risk. Markets apply a structural discount due to China-Taiwan tensions. However, TSMC is expanding manufacturing in the United States and Japan. Western governments treat semiconductor supply chains as national security assets. This reduces long-term concentration risk. In fact, geopolitical tension may strengthen TSMC's strategic importance globally. From a long-term structural perspective, TSMC remains a core AI infrastructure asset. It controls the manufacturing bottleneck of the global AI ecosystem. Short-term volatility may be driven by Federal Reserve policy. Bond market moves geopolitical headlines, but structurally, AI demand is early cycle. Advanced nodes are supply constrained. Market share dominance remains intact. Institutional positioning strategy. Maintain core exposure. Add on macro-driven pullbacks. Hedge broader market risk, not TSMC-specific risk. Final verdict: TSMC is not a momentum trade. It is a strategic long-term compounder at the center of AI manufacturing. And in the AI era, controlling silicon means controlling the future.